So when it comes to assumable mortgages, one of the most common questions we hear is, but don't you have to bring in a huge down payment to assume the loan? Fair concern. After all, the idea of bringing in tens or even hundreds of thousands of dollars in cash to cover a seller's equity sounds daunting or intimidating. Unfortunately, this assumption, pun intended, is also one of the biggest myths holding buyers back from one of the smartest mortgage strategies available in today's high interest rate market. So in this video, we'll break down the truth behind the assumable loan down payment myth, explain how much you really need, and reveal why assumable mortgages may still be your best option, even if you don't have piles of cash on hand. So first, let's define what an assumable mortgage actually is. So an assumable mortgage allows a home buyer to take over or assume the existing mortgage on a property, like stepping into a seller's shoes, including its remaining balance, interest rate, and repayment schedule. This means if a seller is locked into 2.75% fixed rate in 2021 and you assume that loan in 2025, you get that same 2.75% rate even if current rates are above 7%. That kind of savings can mean hundreds, if not thousands of dollars monthly in different payments. So what's the catch? Well, let's address the elephant in the room, the assumable loan down payment. The myth goes like this. When assuming a mortgage, you're required to pay the seller's equity in full, out of pocket, at closing, blah, blah, blah. So here's an example. So a seller owes $300,000 on their mortgage, but the home is worth $400,000 and they're selling the home for $400,000. That means the buyer would need to come up with $100,000 as the difference as a down payment, right? Well, not exactly. So this overly simplistic view doesn't take into account the tools and strategies available in today's mortgage landscape. Yes, you will need to account for the seller's equity, but that doesn't mean you have to bring the entire amount in cash. In fact, many buyers are successfully assuming loans with as little as 10% down, thanks to smart financing strategies. While there's no fixed requirement, having at least 10% of the sales price available, whether in cash or financing, makes assuming a mortgage far easier and opens up far more home options. So bringing in 10% of the sales price as your down payment will give you access to the widest selections of assumable homes. Basically, the world is your oyster out there. The most competitive offers and the greatest flexibility is what you're going to receive when you want to structure a deal when you have at least 10% to put down. Yes, you can assume a loan with less than 10%, especially if the seller has a low equity position, but your pool of eligible homes will be smaller and structuring that deal may be a little bit more challenging. So the homes you qualify for will be fewer and further between, and the terms may be less favorable. So if you want a real shot at a high quality assumption, prepare to have at least 10% of the purchase price ready to go. So let's say you find your dream home and it's got a juicy 2.5% fixed rate mortgage that you can assume. The catch? The seller has $90,000 in equity and you only have $40,000 saved. So here's where secondary financing comes in. So just like traditional mortgages, buyers assuming loans can explore secondary financing options to bridge the gap between the assumed loan balance and the home's purchase price. So this can take the form of a few different things. One would be a second mortgage, a home equity line of credit or HELOC, seller financing, also known as a seller carryback. You can get private financing from investors or even alternative lenders. So each option has its pros and cons, but the key takeaway is this. You're not limited to cash. The assumption process can be flexible and there are viable solutions to cover seller equity that don't involve draining all of your savings. So let's be clear. The need for a down payment isn't unique to assumable loans. Traditional mortgages almost always require a down payment as well. So in many cases, you'll need at least 3.5% to 5% down for FHA or conventional loans, and more if you want to avoid mortgage insurance or access to better rates. So when people balk at the idea of needing 10% down for an assumable loan, they're overlooking the reality that a down payment is already a standard part of the home buying process. So what's different with an assumable loan? What's different with an assumable loan is what you get in return, which is a dramatically lower interest rate, no new lender origination fees, and often a smoother, faster closing process. When you factor in today's high rate environment, the monthly savings can be massive. We're talking hundreds of dollars each month, potentially thousands of dollars each month, and tens of thousands to maybe hundreds of thousands of dollars of interest saved over the life of the loan. So the myth about large down payments for assumable loans sticks around because most people, including many real estate professionals, aren't familiar with how assumptions work. They assume, again pun intended, that you must either match the seller's equity in cash or walk away. The truth is, assumable loan down payments are flexible, and platforms like Yumi Projects are designed to help buyers navigate that exact challenge. At Yumi Projects, we guide buyers through the entire assumption process from start to finish. We don't just list homes with assumable mortgages. We work with sellers, we work with buyers, and we work very closely with loan servicers to create a seamless experience. So our team identifies and vets properties with assumable mortgages. We coordinate with loan servicers, and we handle all communication between all parties. We help structure deals using primary and secondary financing. We ensure your assumption file is complete, accurate, and positioned for a quick approval. We've helped hundreds and hundreds of buyers successfully assume loans with as little as 10% down, and we can help you do the same. So let's recap. You do not need to bring in 100% of the seller's equity in cash. You can assume a loan with as little as 10% down and sometimes less. Secondary financing options make assumable mortgages more accessible compared to traditional loans. And compared to traditional loans, assumable mortgages can deliver huge long-term savings. So the next time someone says, but you have to bring in a big down payment, confidently say, not necessarily. So at Yumi Projects, we're here to help you unlock better financing, smarter home deals, and a more strategic path to home ownership. So no myths, no confusion, and no unnecessary cash grabs. So if you're ready to find your assumable home loan dream, start your search at yumiprojects.com or contact our team to learn how we can help structure your deal.